G'day everyone, welcome back to Pete's Investing Updates. In this strategy edition, we'll be talking about comparing trading stocks using the CCI versus the moving average crossover. But as always, don't forget to review our channel playlists. These are updated every week or as they happen, such as this one will be posted in the strategy playlist. We also review weekly stock prices and we review some world indices using CFD trading. And these are the in the strategy playlist. We've got some simple trading strategy to follow, the average down process, and some money management ideas to look at into more detail. Again, we're not offering financial advice. We're simply covering this as an educational video series. So let's get started. So we're going to be looking at the CCI average down process from the 15-minute chart and how that compares to the daily chart. We're looking at comparing the moving average crossover versus the CCI approach, and what instrument should you be trading and what not to trade. So let's get first stuck into the normal chart we look at. And this is, you're probably familiar with this, but this is our the normal program we follow, and this is over a 15-minute time frame. And let's go back to the Commonwealth Bank as an example, and this is covered over roughly a 5-month period, so it goes back to the start of 2020. So what I've done here is, this is a profitability. So it's generated, it's hard to read that, but it's generated about $1,000.65 in that roughly 17-month period for trading stocks. And here we're trading $2,000 amounts for every entry we make. And again, I'm not going to go into detail in terms of how we average down in this one. Please refer to the trading strategy videos on how we enter and exit these ones. And again, this is just an evolution of those strategies we're following in this video series. But this is a 15-minute chart, and I'm just basically trying to show you that we've generated just over $1,000 in 18 months. But if you look at it on the new daily time frame, and I've gone back here to the start of 2020, that's where that starting point begins. This middle profitability chart shows at $744 trading on a daily chart. So this is our normal strategy we use on a 15-minute chart. The only difference I've made was I've changed from a CCI 100 to a CCI 5. So every time the CCI breaks, the moving average of the CCI 100 breaks above the zero, like it did there, we enter the trade. And we exit the trade when the CCI falls below the zero. That's what that little trade there shows. The CCI came below, broke above the zero again, we entered the trade. So over that roughly 18-month period, it's generated $744. These other two profitability charts are now using the moving average crossover, which I've introduced today. Just hold that there for the moment. You can see there, the pink line is a exponential moving average of 60, and the black moving average is a weighted moving average of 100. What it's doing there, whenever it crosses, like it did there, we enter the trade. So there's two strategies that are being executed here. One of these, and I'll go to this chart. This is the original program. So over the 17-month period, for each of these stocks we've back tested, and as I mentioned earlier, the Commonwealth Bank generated $744 in that period, with a drawdown of $183. So basically a revenue generation of percentage of about 400%. So if you just make that a positive, that'll be 400% positive. So all these other stocks have generated overall an average of about just over 100% return. So it's generated 2,600, the drawdown of 2,400. Now, I won't go into each of these respectively in detail. I'm just going to demonstrate on the Commonwealth Bank to keep this video a bit shorter than normal. So that's our normal strategy, but we've changed it from a CCI 100 to a CCI 5 for the daily. And just to compare that with the 15-minute chart, again, this is a result of the 15-minute chart. We're using $2,000 investment amounts. You can see there, 1,064 over the same period, approximately. You can see there for all these stocks on the 15-minute chart, it's generated just under $7,000. But for the daily chart, it's generated 2,600 using the CCI 5. So what I've done then is, instead of using the CCI 5, I've then gone and started using a moving average crossover of MA60 and MA100. So there's two differences here, and I'll explain what both of those are. This one exits when it reaches a 5% gain. It exits the moving average cross. So using that approach, and I'll explain what the not using the close it means. This one uses a close it. I'll explain what that means in a minute. Whenever it reaches at least a 5% minimum gain, it exits the trade. So what it says basically is, going back to this, so this 398 program 398A4, that's just my nomenclature I've used, that exits on a 5% gain minimum. So what it's saying is, this is this bottom profitability chart here, it's generated $575. Now, again, that's less than the CCI, but overall, I just want to emphasize, overall, that is less than the CCI program. But overall, you can see here, for BHP, that was still less than. For Volkswagen, that was greater than. But overall, it generated, for all those stocks combined, it generated $6,800 approximately versus $2,600. So I'm just showing you the Commonwealth Bank as an example, but we can cover a couple of those in a minute. So this one uses a MA60, MA100 crossover at a 5% minimum gain. This program uses the same 60-100 crossover, except it says it doesn't look at a percentage gain, it looks at a price high-low average gain. So what that means is, I'll try to explain it in this little chart here. It says at this point, at the last 100 bars, and again, we're looking at a daily chart here for the same CBA chart. For the last 100 bars, what was the average high and low range? So for example, let's say that point there, the high was 95.43 and the low was 93.85. So that was roughly $2.50 range. So whatever that was for the last 100 bars, that calculates the range. So what it means is, this program up here, it says when it hits that minimum range, at least, it exits the trade. So instead of using a percentage gain, it uses a minimum range. Now the Commonwealth Bank in this example, it's generated here 575. This is a live chart at the moment. We're trading now at Monday morning. It's a live chart. It's generated 574, same as this one. So these two programs are generating the same revenue. Let's go to very quickly to another. So you can see here 576, 576. So they're the same revenue versus 744 for the CCI. Let's go to one that's a bit different. Let's look at, let's say Caterpillar. Caterpillar is a good example, okay? Okay, so you look at the 15-minute chart first. Caterpillar's generated $814 of revenue over the roughly the 18-month period. Just to go show you back here. 814, and this is the original 15-minute data table. So again, that's generated 69.03. Caterpillar's generated 824 for 15 minutes. If you go back to the daily breakdown, on the daily chart, that's what this is. It exited the CCI trade here when this CCI moving average broke below, and it generated $384 versus the others have generated $1,804 versus $1,804 for both of those. Again, both of those have been consistent in their profitability, and that's shown here by these results here. So these two MA60 and MA100 crossovers have generated the same for that as well versus the CCI 5 for Caterpillar. Now, there have been some differences in the other ones, and that's why this one is slightly more than that one overall. So again, I'm comparing that to that amount for the crossovers. So that's 482, 413, 1887, it's the same, 188 versus 82, 2056 versus 1624, 744 versus 480. So allowing for that high-low average price gain versus a 5% gain has generated more profitability. Now you've got to be careful you might say, okay, well, let's increase that to 10% gain minimum. Let's see what that does. Make the change on this one here. That's the, let's make that 10%. It's going to do one of two things. It's either going to generate more profitability, or it's going to take a longer time to reach that target. Now, in this example for Caterpillar, I'm just looking at this bottom line here. It's still generated the same as the other one. So 1804 hasn't changed. So reaching the 10% for that one hasn't changed. Let's go back to Commonwealth Bank. What I'm doing here is just basically showing you the back testing and how to compare like for like. So 575 versus 575, that hasn't changed much. BHP. $630 versus $812. So you can see there, these bars down here indicate for this program down here, which we changed from 5% to 10%, that has taken longer to reach the target. 628 versus 811. So that's, we're looking at that one, it's BHP. So we're looking here at BHP. 480 versus 744. So we changed this from 5% to 10%. So it went from 480 to 620. So let's just watch these bars down here. I'll change this back to 5%. You'll see what happens. These bars will become shorter, which means it exited at a shorter target range. I'll make that 5% again. Watch these bars down here. See, they exited at a shorter time frame, which is according to our initial strategy here. So it's gone now back to 540. So I just want to emphasize that the back testing depends on how you tweak the system. So overall, on a daily chart, this shows just the monthly averages of each of those strategies. This one comes very close to have generated what it does to a 15-minute time frame. That's why I traded the 15-minute time frame initially for the last 6 months. If you've been following my videos, but tweaking that again now using the high-low averages of the last 100 days. That's what the close it means. Again, refer to my strategy videos from the past. That generates about $430 a month, which is $7,700 for these stocks. That's still better than this one. So this 62903 for the same stocks on a 15-minute time frame compares closely to this 5% gain. But again, using this close it approach, we've actually tweaked it to be a better result using the high lows instead of just a standard percentage gain. So we've talked about the CCI average strategy on a daily chart versus a 15-minute chart. Comparing the moving average crossover versus CCI approach, it allows us to stay in the trade longer using the moving average. And the instruments you should be using in trading and what not to trade. Now, if you've been following my videos, and again, if you followed my strategy videos from the past, I've said before, you want to get good blue chip shares that have had some track record of paying dividends. Because if you're stuck in a trade for a particular period of time without closing out we want cash flows basically. And that's another reason I've been doing 15-minute time frames. Because of the quicker entry and exits of the trades, you can actually gain some cash flow versus being in a daily trade. It's a bit longer time frame. You can see here both of these moving average profitabilities, they've got a longer time frame. They're in there for months. So while you're sitting there in there for months, waiting for the exits for the right profits to be generated, you want to be receiving dividends. So in other words, you don't want to go into speculative stocks which pay no dividends. Again, as I've said before, in speculative stocks, when they do well, they do really well. But if they do badly, they can do really badly. And you don't want to be stuck in a downtrend on a speculative stock with no benefit or side benefit such as dividends. Also, we can easily trade these using commodities or foreign exchange currencies using CFDs, and that's what I do with my indices. When I trade the indices, I use CFDs, and I buy about the equivalent of contracts required for each of the CFDs. And again, if you refer to my indices playlist, you'll see what I'm doing there. I'm only going long for the indices. And if I was going to trade, and I don't trade Forex and I don't trade commodities because they don't pay dividends. Again, if you get stuck in a downtrend on a dividend or if you get stuck in a downtrend on a commodity or a foreign exchange currency, you get no benefit. You're paying fees for nothing. I could go short, and this strategy works in a shorting approach, and I'll put that out in a separate video. But again, going short, if we go short on indices, for example, on the ASX 100 or the US market, when I'm going long, I'm receiving dividends when dividends are due in those indices tradings. If I go short on those indices, for example, I have to pay out those indices to whoever's going in the opposite direction, i.e. going long. So again, I avoid going short, because if we get stuck in an uptrend and I'm going short, we're paying dividends out as well as any holding costs. So again, I choose to trade blue chip shares that have got a good track record, and I avoid trading in stocks or instruments that don't pay dividends. You also notice I don't have stops in my trading. I rely on averaging down. And again, if you choose the right blue chip stocks that have got track record, they generally go in at least a sideways direction, which is still profitable for us, or an upwards direction. And if they do go down, you can actually ride the storm and get out of it in a decent way. So anyway, that's the video for today. Again, click on the subscribe button, the notification bell, and like this video to support the channel, and we'll speak to you guys in a future video. Thank you.